we really want these to be educational, informational, and however ways that we can help you. We are going to be hearing from Brad, Stock Market Nerd, a little more into companies that he owns that reported this week. We're going to be hearing about UpStart and Trade Desk, TTD and UPST. Definitely, the purpose behind a lot of this isn't necessarily, oh, here's what a company did, a pitch on it, but someone like Brad who puts a lot of work in, puts a lot of time in on the back end, hearing what the type of stuff he's looking at, all the information that he gathers and the type of stuff that he gathers, and really what makes him excited, I think, is the underlying takeaway here, maybe some of the terminology as well. And we also have DecadeInvestor up here to give us some really fantastic thoughts on wealth management, building wealth over time, which is really fantastic and a really important concept. So I'm excited to hear more about that. With that, we're going to get us around. I want to let everyone kind of join in, say hello, hear how your days have been going, anything top of mind. With that, I want to throw it over to you, Brad, first. How are we doing?
Yeah, doing well. Kind of a boring week for me. Only 2 earnings reports, but honestly, I'm very grateful for the boringness. As you said, gonna talk through UpStart's report and a lot to chat about there, and then Trade Desk report, which also has a lot to talk about there. So yeah, I'm excited to have a DecadeInvestor on. I always enjoy listening to him, and thanks for having me.
Appreciate you joining in as always. DecadeInvestor, how we doing? Glad to have you. Great to have you on this first Space of mine. I'm super excited to hear you talk. I've heard you talk a bunch of time at Wolf Space and other places, so I know the quality is there, but very excited to have you here. How has your week been so far? How you doing?
Man, I'm good. Thank you for having me on here. I live in the Midwest, so woke up to a snowstorm and it's snowing outside, but can't complain about that. But on the investing side, been just crazy diving in and researching stuff. What I do, just research and try to give out the best information I can. And so week's been really good. Glad to be here and excited to talk about some really interesting data points that I've been finding the last few weeks about long-term investing and people trying to time the market and all that stuff. So really excited to share that here on this space.
And then just one more thing I want to add. Evan, if you want to throw that the spaces into a tweet, I'm happy to retweet that so we can get some more people in here if you want.
Likewise.
Perfect. So look, the tactical intros there. If you notice, I kept my mic unmuted there, which I always try to mute it. I was getting the post out. So that actually literally just got posted 10, 15 seconds ago. I linked it in the nest up at the top. If any of our listeners in the crowd want to also support us and help us and get more people in here, feel free to engage with that tweet above. Honestly, even just liking it does help. Twitter algo likes to reward engagement and send it out to all of your audiences. So even just leaving a like is helpful above. Really appreciate that. And yeah, perfect. With that, we got about 162 people, a very solid turnout right here at the start within 5 minutes. I will start us over with Brad. Maybe, honestly, Brad, maybe we do a little sandwich here. We hear about UpStart, then we go UpStart or Trade Desk, whichever one you want to talk about first. We could throw it over to DecadeInvestor, get nice thoughts in there, and maybe come back to you after. Break it up so we're not...
I think that sounds great. Yeah, one at a time definitely sounds like a great plan so that we can get Decade into the mix more frequently. But I will start with UpStart, a pretty popular company on Twitter. Just a few things to mention firsthand. They did announce a $400 million share repurchase program. It's not super common. We see a company growing above 60% year over year, buying back their stock, but that's what $1 billion in cash on the balance sheet and very little debt and also deep profitability gets you. So just wanted to start off with that. But from a demand perspective, they guided to 260 million. They posted 305 million. Analysts were expecting around the same thing. So it's around a 16-17% beat, depending on which vendor you're using for estimates, which are roughly the same. They do vary a little bit, but 16 to 17% beat. And then partner loans originated rose 36% sequentially, 300% year over year. Two things I want to point out is conversion rate and percentage of loans fully automated, because in Q3 of 2021, this company dealt with a fraud incident where some bad actors were accessing loan quotes for the company, and they had to pull back and insert some manual controls into their largely automated processes to kind of rein this fraud incident in. Encouragingly, we saw conversion rate bounce right back to that historical trend of expansion, back to 24.4%, which according to the CFO Sanjay Datta, every basis point above 20% conversion rate is evidence to UpStart to lean in more aggressively to growth. So this is just evidence that they have more productive dollars to spend. In terms of bank and credit union partners, This was actually a pleasant surprise to me because Upstart had only announced 2 or 3 new partners during the period, but they generally wait several months until after the relationship has began to actually tell us who the partner is. But they did add 11 partners sequentially, and that was from 31 partners to 42 partners. So pretty meaningful growth there, and 300% growth year over year again. And then loan funding source. Want to move on to that and cover that because I have a deep dive on Upstart that explains all of this, so I won't get it too far into it because it's pretty dense and pretty complicated. But just keep in mind that we, as Upstart investors, prefer that these loans that Upstart's sourcing that are originated by their partners are actually retained by these partners and not resold to Upstart and pushed through capital markets to find other funding routes. So the proxy for this information comes from the cash flow statement, and it's volume rebought from originator and not retained, divided by total volume, and that really gives us a sense of their capital market reliance. Over the first 9 months of 2021, that was at 76.7%, which had ticked up versus 73.8% year over year. Now, in this quarter, including those 9 months of 76.7% weighting, it fell to 74.1% year over year, and it actually fell in the quarter to 69%. I was not really expecting this trend to revert. I was hoping that it would revert as soon as possible, but wasn't expecting it to really normalize until we entered further into 2022 and put more distance between ourselves and elevated deposit levels from stimulus checks and eviction moratoriums and all of these unique macro events that really drove capital market demand. So we'll be continuing for that trend to continue falling over time. And this was just evidence that really can be the case. Moving forward, what else is important to cover from a profitability perspective? That's always important to cover. Upstart's EBITDA guide, it beat by 75%. It was supposed to report just using its net income guidance and the midpoint from its revenue guide. Supposed to report around a 7% GAAP net income margin. It posted a 19.3% GAAP net income margin. So pretty stellar outperformance. I mean, obviously, I think so because I own the stock and I'm biased, but I think we can all agree that that's pretty impressive. Looking forward to guidance. So this was really the sticking point for me with Upstart heading into this quarter because of all these macroeconomic factors that I talked about. How many of them served as headwinds and tailwinds for Upstart? It was a very mixed bag. So it was hard to kind of gauge what in 2021 was unique to Upstart and what in 2021 was unique to stimulus checks and elevated deposit levels from institutions. But for 2022, which shouldn't be nearly as impacted by these unique factors, it raised its revenue guide by 16%. So we've gotten used to Upstart having these massive beat and raises, but rightfully so. A lot of the skeptics just talked about, this is because stimulus checks are out and because default rates are falling, and that's artificially propping up demand. But this is just direct evidence that the 15.7% raise, expecting nearly 70% growth off of the heels of this phenomenal 2021, just evidence that that's not really the case, and this is more sustainable. And I want to skip ahead a little bit to Sanjay Data. I don't know if it's Data or Data, so I apologize if I'm mispronouncing it, but I'm going to call him Sanjay for the purpose of the call. But he's the CFO. He's been telling us, holding our hand over the last year, telling us that default rates are going to rise, cumulative net loss rates are going to rise as we exit the stimulus era time. So they've been guiding to that directly. And here's a quote from the call, just addressing that point and reiterating that point. So as we have anticipated, default rates have risen and our loans have been priced accordingly. We expect no adverse default rate impact on our volume or economics. Rising defaults are solely a product of change in customer mix. Rising absolute default rates correctly predicted is not a bug, but a feature of our platform. So looking back at, we get a lot of third-party data just because of how regulated the credit industry is. So a free resource that I use constantly is KBRA or Kroll Bond Rating Agency. So we were starting to see in these new surveillance reports that they were coming out with rising default rates, rising cumulative net loss rates, and that some people took that to be a red flag. But what we have to keep in mind is the mix shift directly correlates with default rates for a specific transaction. And this mix shift was quickly moving towards more Class B and Class C loans and away from Class A. And that's not Upstart doing it on its own. That's highly regulated banks and highly regulated credit unions that funnel deals and offers to Upstart, giving them the permission to lower credit parameters on their behalf because they have confidence in Upstart's algorithm and more confidence over time. more evidence of that is the FICO minimums that every single lender has been using for the last 50 years to drive risk calculation and underwriting. 7 partners have now dropped all FICO minimums in favor of UpStart's algorithm. That's versus 4 quarter over quarter and versus just 2 quarters ago. So really positive momentum there. Wanted to talk about auto. So auto is their newest product, and I was not expecting a lot of color here, but we did get some color here, which I found encouraging. So it guided to 1.5 billion in auto transaction volume run rate for 2022. Just keep in mind that this company did it did 11.7 billion in total transaction volume in all of 2021. So for a brand new product, getting to a $1.5 billion run rate in the first full year of its existence in terms of the indirect product offering, that was pretty exciting to me personally. Not to mention the fact that we've all really been expecting the margin profile of the auto business to be way inferior to unsecured, because UpStart, it's a more mature industry, so less inefficiency, so UpStart can provide less value. That was the thought process. But what we didn't really take into account is that UpStart is going to take a larger piece of the net interest income from these transactions and from their bank partners. So while the take rate from a referral fee and from a platform fee and servicing fee is not going to be 6.1% like it is for unsecured, the unit economics and the margin profile of the auto business, they're expecting, and I quote, to be identical to the unsecured product. So that was another pleasant surprise. Sorry if I'm sounding too much like a cheerleader, but it really was a positive quarter, and not too much to pick at. The only thing that I will pick at is the 2022 EBITDA guidance, which was about 9% below expectations. Now, that was explained as intentional and controllable and a function of ramping up the auto lending business, which is lower margin right now as it scales and will weigh on margins for the next 2 years before it reaches maturity and has that similar margin profile. They also are planning on accelerating hiring trends into the year, and they have 3 new products: micro lending, small business loans, and mortgages, that they're all working on in R&D stage right now, that are all weighing on margins. So the most important thing is that 15.7% demand raise for 2022, and we also have to keep in mind that this company has a short history, but a consistent now 6-quarter history of just massive beat and raises. So it wouldn't be all that surprising if they end up way above this $237 million guide for 2022, just because in the call they explicitly told us how pessimistic they were being in their macro assumptions and how careful they're being in their guidance. And despite that, we still get this $1.4 billion top line guide. So just exciting to think about what it can look like for 2022. Some notes from Dave Garrard. If there's anything that I didn't cover already, it looks like I got to everything. And so he's guiding to rooftop acceleration, or a rooftop adoption acceleration throughout the year. That just means how many car dealerships are using UpStart Auto Retail, which is the product culminating from its Prodigy purchase. And that's also more than tripling year over year, and they're expecting that to accelerate. So not much to pick at. Really pleased with the results, just because I was nervous going into this report due to the fact that all of these crazy uncontrollable factors have been playing out over the last 18 months, which made understanding how much success from UpStart was sustainable and how much was unique. And this was just a very encouraging data point, pointing to it not being unique to the macro period that we were in, but it being unique to UpStart. I have been, not to toot my own horn, but I have been saying for the last several months that this company's loss ratio outperformance was not unique to the pandemic period, but has been unique to the last 9 years of its existence. And they've also told us that they're expecting the consumer to revert to pre-pandemic periods while they were already outperforming. So to me, it made sense that this outperformance would continue, but always I reserve the right to be wrong, and was fortunately grateful to not be wrong here. Not commenting on the stock price movement. It's one of the most volatile stocks in public markets, and day to day taking away meaning from daily ticks is anyone's best guess, but the numbers are really what I'm talking about. The numbers were very good across the board. And every key performance indicator that I was hoping to be strong was stronger than I was expecting. So yeah, thank you, Dave Garrard. Thank you, UpStart, for making me look smarter than I am. And I will pass it on to Decade Investor to drop us, or to hit us with some knowledge, and then move on to Trade Desk later.
Perfect. Appreciate that, Brad. Thank you as always. I know Brad always has these huge deep dive thesis on here, but somehow there's even deeper. He likes to go deeper on his Substack. So that is in his bio. Make sure you check that out. Perfect. I will keep us moving and slide it over to Decade Investor. I saw one of your tweets yesterday talking about how, what your plans are for the future. I love the concept of kind of DCAing into this broad-based index over time. I think, for the average investor, that is definitely one of the best ways to do it. I would love to maybe hear more, a little bit about that, and then kind of anything else you have prepared, anywhere else you wanted to take it.
Yeah. So again, thank you all for having me, Brad. Always love when you talk, man. You put out some really good stuff, and so excited to hear about the trade desk here after this. So two things I want to cover, because I think it's really important when we talk about long-term investing. I know that it's not the flashy stuff. It's not the stuff that that we're going to see run up like a Bitcoin or some of these more individual stocks, but everyone at some point, in my opinion, needs to have a long-term portfolio where, whether it be you just buy into a broad market fund like I'm going to mention here, or you buy into stocks and you're not trading, you're just buying into things you love for the long term. I think it's very important, and I think that's where you can build wealth where it sustains over the long term, and that's kind of the goal, right? We all want to reach financial freedom and all that stuff. So when it comes to dollar cost averaging, I think there's a really interesting study I found a while back, but I want to kind of revisit, because I think it's really interesting when you look at this data. Because I think, obviously, when everyone talks about investing in the stock market, what's their first thought? It's like, oh, I'm just going to buy low and then, sell high, or just keep buying low. I'll just wait till the next dip, buy, and then, never sell. I'm just going to buy low and time the market, which sounds great in theory, right? I think we would all love to be able to time the market. I think if I had one superpower, my superpower would be to know what the market's going to do in the future. But we don't, and no one knows that. And so the second best option is to simply just dollar cost average your money into there. Because if we look at some data, if we were to act as if someone knew when the absolute bottom of the market was. So what I mean by that is, if we look at like the S&P 500 on a graph, and let's say at for example, the S&P is right now at 4,400 is where the S&P is. Let's say at today, right now, at 4,425.32 is the absolute bottom that the S&P 500, well, it just fell down, but where the S&P 500 would be never again. So the lowest it would hit is 4,420. Let's just say for this example. It would never see that again. So someone would buy. And then in the future, they wouldn't buy again because it's going up until the next absolute bottom would be. So let's say it runs up to 4,480, and then it dips to 4,430, never sees 4,430 again, and runs back up again, right? So we were able to, absolutely time the bottom, okay? So if someone were able to do that, and we compare that to someone who just simply dollar cost average from 1970 to 2019, okay, that's a pretty good time frame. Basically about 50 years, 49 years. From that time frame, if someone was able to buy the absolute bottom, which is not possible, but let's just say for the sake of this example, versus someone who was just simply dollar cost averaging into their investment, and this is, when I talk about this, I'm talking about the overall S&P 500, not like every single stock. I'm just talking about the overall S&P, a broad market fund. The absolute bottom buyer outperformed that dollar cost average investor by 22%, which sounds maybe great or not. But if we break that down to an annual outperformance, it is only a 0.4% outperformance per year. So what that's saying is like, even if you time the bottom perfectly, your outperformance isn't that substantially greater, 0.4%, 40 basis points better than someone who just simply dollar cost average into, an S&P 500 or, a broad market fund. Again, not every stock goes up over the long term. Not every stock, succeeds. Some fail, they go bankrupt, whatever, a lot of reasons, but I'm talking about the overall market. So when you see that and you're like, okay, if I just dollar cost average, because I can't time the absolute bottom, right? No one can. Maybe if you're Nancy Pelosi, you somehow have some luck, but other than that, no one can dollar cost average. So no one can time the market. So why not simply dollar cost average? Even in a time like this, I had someone comment on my YouTube. I made a video a few months ago or a few weeks ago on the S&P 500 ETF SPY, the SPY. and someone commented and said, this would be great, but it's a bad time to get in the market now. And I think a lot of people really think of the idea that, hey, like the market's down, I shouldn't be getting in. I should wait until A, the market's going to go down even more, so I'm going to buy, or B, like the market's down, I want to buy when it's up, right? That's like backwards thinking. So really, the easiest way to take emotions out of everything is just simply dollar cost average. Okay, I get paid every 2 weeks, every other Friday, or whatever the day of the week you get paid, or once a month, every week, whatever it is. And of that, I'm gonna put in 20% of this paycheck into this broad market fund. Not even care about what the market's up, it's down, because if we're buying into a fund like, let's say, the S&P 500, in 10 years, when you dollar cost average, unless something crazy happens where like it's a black swan event where who knows, and the S&P 500 in the next 10 years goes to zero, like what's in our accounts won't matter, right? I can promise you that. Everyone on this call, if the S&P 500 goes to zero, then who cares? Like, we won't even have Twitter. Like, there are going to be other issues going on than what's in our investing accounts, right? And so if you just want to, like, the easiest way to take emotions out of the game, just say, hey, I believe, and this is me speaking, but I'm saying if you believe this, if I believe the S&P 500, which contains the 500 largest companies in the USA, right? Like Apple, Microsoft, plus 498 more. So in companies we don't even, probably don't even, you might not even heard of. If you believe that those companies will continue to progress, or at least you think of it as it, because it changes, right? The top 500 doesn't, they some add, they fall. So it's because it's based on market cap. So if you believe the 500 largest companies in the United States of America will continue to progress, people in technology will continue to progress in the future, then simply dollar cost averaging is going to be your best strategy. And if we look at some other data, this is from 1926 until 2017. So I don't have, this data doesn't show the last few years, but it's pretty much is beyond the point. The point is this: if we look at the average bull market meaning the stock market is going up, right? Bull market. The average bull market period in that time frame from 1926 to 2017, the average bull market lasted 8.9 years versus the average bear market being down, not good, right? The kind of what we're in now, not necessarily, but this is what would be considered, right, similar. The average bear market period lasted 1.4 years. So the average bull market, the time when your portfolio is going up, right, the overall market, again, I'm talking about the S&P 500, when it's going up, lasted 8.9 years versus the average time it was going down when it was in a down market was 1.4 years. So a little around 6 to 7x the amount of time we're in a bull market than we're in a bear market. And if we look at the total return in those time frames, that bull market, the average bull market, had an average cumulative return of 468% versus the average bear market had an average cumulative loss of negative 41%. So what this is trying to show you is that, especially now, right? This, if you believe in, again, I'm talking about broad markets. If you believe in the S&P 500 and it's down for the year, right, 7%, almost 8%, 7.7, then this is a great time to get in, and this is a great time to continue to buy, because hey, yeah, even though these are the same prices we saw a few months ago, but if you believe it's going to progress in the future, then just keep buying. Don't mess up your dollar cost average strategy, right? That's what I tweeted yesterday is my strategy. I've been diving really heavy into crypto and NFTs and stuff like that. But I'm still putting in you can go see my tweet. I'm putting in a lot of money every single month in the S&P 500, just simply dollar cost averaging into it. And that's what because of the data points. Hey, I can't time the market, but even if I could, based on the data, I wouldn't be doing much better than what I would be doing just simply dollar cost averaging. And B, when we see a bear market, it's lasting about 1.4 years, but when we're seeing a bull market, average historically is 8.9 years. So when you combine those two things, and it's like, hey, simply, long-term investing it's in the name. It takes time. You're not going to get, 2021 was an anomaly, but you're not going to get 30%, 40% every single year if you're investing in a simple broad market fund. But over the long-term investing, again, if the S&P 500 doesn't have a black swan event where it goes to zero, every 20-year time frame, since the 70s in the S&P 500. So from 1970 to 1990, 1971 to 1991, 1972 to 1992, every 20-year time frame, the S&P 500 has had a positive return. So you would have made money in that 20-year time frame. So you can kind of taking pieces and make your own conclusion. But for me, I can sleep well at night knowing when I put my money in the S&P 500 or in the broad market fund like the NASDAQ or something like that, where, hey, you know what? There's gonna be times in the short term when I will be down, where my investment will be negative. But again, bull market, long-term investing lasts longer than a bear market historically. So I can sleep well at night knowing that if we're in a downturn like we are today, this year in 2022, with the S&P and the major indexes, that I can sleep well at night knowing, hey, I believe it will recover because it has recovered every time in the past. And I'm going to my strategy does not change. Simply dollar cost average, because that is what has been proven to work for many, many investors. And I'm not going to be the one to try to find a new thing. I'm going to do what everyone else has done and simply just dollar cost average into broad market funds. And I think that is a great way to, you can combine that with your more risky plays. You're more, like my tweet yesterday, I'm doing some more risky stuff, but I'm still having the solid foundation of dollar cost averaging into broad market funds. And my long-term investing will be the reason that, I reach financial freedom and do really well with my investments, because I just simply dollar cost average, and the market's going to do what the market's going to do. And if it's done what it's done in the past, then, the bull markets are measured in years and the bear markets are measured in months. So that is my take on long-term investing.
Love it. Love it. I want to dig in there a little bit more. That was such great concepts and thoughts there. I definitely do agree with it. One thing I do want to get at here is, like, how much time a week does that strategy take you to implement?
Yeah. So when it comes to dollar cost averaging, in one of my portfolios, it is completely automated. So I mean, it takes me 0 minutes, 0 seconds. It's automatically pulled out of my out of my bank account, automatically invested into my holdings within my portfolio. And I rarely check it. It took me 5 minutes to set up that. My other portfolio that I have, another one that holds some like ETFs that I have. That one, I don't have it set up automatic because I'm putting in a lot more money. So I want to just kind of control that a little bit more. But even to do that, to go in there and buy every week, it takes me no more than 3 seconds or 3 minutes, really. Just I have to ACH the money in, buy what I want to buy, and that's it. So and when you automate it, it can take you the longest thing in automation, when setting up automation, is setting up the automation. And then after that, it's completely automatic. So you can literally build wealth, automatically pulled out of your account without you having to lift a finger, and your account's growing. So auto investing, automation, that is key. That is huge. It takes literally, eventually gets to the point where it doesn't take any seconds out of your time.
I think that's the big key here, is that, like, everyone is basing their returns off these broad-based indexes. I think if we ask Brad how much time he spends a week on this stuff, myself, Wolf, we're all say very similar, high numbers. And there's a specific person, and there's, types of ways that you can beat the market by putting in this amount of work. But for the person, who's has a real full-time job doing whatever, the ability to invest and get that market return with 0 time, we'll say, a week, maybe 1 minute a week on average, like that is so hard to beat. And you got to really take, when you're investing and picking individual stocks, how much it is worth for you to put in all that time to see what returns you're getting. So if you've had 2-3 years of underperforming the S&P 500 and you're putting in 30 hours a week, maybe that's where I'm asking myself, what am I doing? And maybe you should just buy the indexes and do that. And I think another point you brought up as well is that, by having your portfolio being a base of these broad-based indexes, first of all, it's very important to say broad-based indexes. Don't go in and buy, a sector-specific name, 10, SMH, RK, whatever it is, and then think you're in these broad-based indexes. We're talking about S&P 500, the total market fund. Even the NASDAQ 100 is a little concentrated in tech, but at least in the better direction, those type of stocks. But yeah, the importance of it, if your portfolio is really built on a base of those, say 50, 60%, and you still have 40% to get that itch of picking individual stocks and doing whatever you want in there. For you, Decade Investor, I know it's passive crypto investing and some NFTs as well. But I think it's just, having that base portfolio for the long term is really important. So I love to hear that. I want to kind of maybe get your opinions on. I know in your tweet you talked about VU, which is the Vanguard S&P 500 fund. Is the S&P 500 your kind of go-to index here? We have any thoughts on QQQ or like a total market-wide fund, or we like S&P?
Yeah, I mean, I think historically, if you actually look at the data, small caps and mid caps, although they are more volatile, they do have a history of slightly outperforming the S&P 500. Now, with that being said, like I said, there is more volatility. The S&P 500 is more established companies. So I do love VOO, but I do complement it with another Vanguard fund that is VXF, which is everything but the S&P 500. So I kind of complement the two. And the reason I do that is because I prefer to manually be able to split up my S&P and non-S&P funds. Buying something like VTI, which is the Vanguard Total U.S. Market ETF, is great, but your small caps and mid caps compared to your S&P are, they're set. You can't change them because that's how the fund's set up. And so I prefer to keep mine a little bit manualized in that sense. But even then, I have some QQQM, which is basically QQQ is just slightly cheaper expense ratio. I think any of those are great. Really, at the end of the day, when you're investing in broad market funds that, like you said, spread out amongst different sectors, rather than just buying like a VGT, which is a Vanguard Information Tech, which, there's I don't know the exact holdings, but I think it's over 100 holdings. There's 100 holdings in this, but they're all infotech, information technology focused. So it's like a QQQ, even though it's really over 50% information technology, you still have some non-tech focused companies in there. But like something like the S&P or VTI, you have your information technology, and that makes up a lot of the fund because of just the market cap of those companies. But you still have non-tech companies. So hey, if Apple's down, even though it's heavy in the weights of that fund, you may have like a Johnson & Johnson or a Ford or something up, right? So there's different sectors within it. I really like VOO. I like the S&P 500. Again, I just like the established companies of it. But I do complement it with some small cap and mid cap as well. And that's just for my own OCD, I guess, of being able to manually set up my S&P and non-S&P funds.
I haven't really heard of the VXF, the entire market besides the S&P 500. That's very interesting. There's a lot of interesting tools out there, and I think that another point in here will keep us moving and get to some stuff. But the tools that are available to investors nowadays to passively invest and really be, diversified across so many different stocks and have a really fantastic portfolio that can get you a lot of exposure on the upside and some protection on the downside, is literally buying 3-4 tickers away, doing whatever, and just automating it each month. We've come a long way to what it was in the past. So that's really great to see. That was some awesome thoughts and information from Decade. Ooh, I almost said Decade Investor. It is. Sorry, Decade Investor, and you could tell he brought it up and had everything to back it up with hard stats and points. Love his thoughts, love his concepts. Make sure you're checking out Decade Investor. Give him a follow. Some fantastic content coming out of his page. So thank you for coming up here, Decade Investor. We'll keep you up here if you got the time. We'll throw it to Brad and let him get on his trade desk. But before we do that, I do want to give my amazing co-host up here the chance to chime in if he had any thoughts or anything that he wanted to share from maybe it's his long-term invested journey or anything that he wants to point out there. But Wolf, you got anything for us?
Just listening right now. Might chime in a little bit more later.
Perfect. Appreciate you as always. Big shout out to Wolf Financial, one of the kings of spaces, if not the king, doing so much on here. Always live, 24/7. It feels like. He's got a bunch more spaces coming later today. Actually, another one coming from the Rippers account. So if you want to see that spaces and you want more content, make sure you're following the Green Raccoon, the Rippers account for that. Enough self promo. Big shout out to the God Blacksburg account, the man behind the Wolf account as well. And I'll slide us over to Brad to hear a little bit more on Trade Desk, ticker TTD.
Yeah, and this one is always low drama and usually pretty positive, and this was no different. Shout out to Jeff Green for 5 years of under promising and over delivering in public markets. I appreciate you. But moving on to the results, so the beat was a little bit smaller than we've expected, or than we've gotten in the past. It was about a 2% beat on the top line, but then the forward revenue guidance was really strong. So they do an at least guide. So they guided to at least 303 million. So they beat expectations or mean estimates by at least 5.3%. So more than doubled the beat rate sequentially, which is always nice to see. In terms of growth trends, we have to keep in mind that we're comping year over year over political spend. In 2020 was certainly a landmark year for political spend. So the growth year over year was at 24%, but ex-political spend was at 36%. And then when looking at Q4 2019, so not 2020, which had all of these unique factors, but 2019, which has a more similar overall backdrop to 2021 than 2020 does, and growth is accelerating ex-political for Trade Desk on a far larger base. So really positive demand momentum, and then margins no different. I mean, this company is posting a 48% adjusted EBITDA margin, a 52% net income margin. I mean that does benefit from the fact that Q4 is their strongest period seasonally in terms of margins and unit economics, just because when demand is strong, this company is wildly efficient and doesn't have a lot of variable costs that grow with that strong demand. So what happens is strong demand ends up flowing down to the bottom line, as we're seeing here. So 52.6% net income margin. That's not what they do throughout the year. They're closer. They're in the 30s and should be in the 30s, which is still phenomenal for 2022. But just wanted to point that out there. That phenomenal result, but it's unique to Q4, so keep that in mind. GAAP operating margin I should talk about, because it was negative 6% year over year versus 33%. But we have to keep in mind that this included a $158 million stock-based comp charge that was paid out to Jeff Green in connection with performance benchmarks. Without this charge, it would have been 33.6%. So it would have expanded by about 40 basis points year over year. And I say this because there's another $616 million left in the package that will vest over the next 4 years. This will hit GAAP margins when the lumpy charges are incurred. There's no schedule on when they're going to be incurred. It's more so along the lines of performance incentives being met. So just keep that in mind going forward. That GAAP margins could be a little weird in future quarters, but EBITDA and adjusted net income margins will account for that. So that's how you can observe the impacts going forward. But moving on to OpenPath and Google, which was really the big announcement of the day. So. Or of the week, I should say. So the Trade Desk announced new tools for publishers to really help to eliminate a lot of the extreme reliance that these publishers have on Google. So Trade Desk is a demand side party, so it works with advertisers. The supply side generally works with publishers. So this product acting as a publisher conduit really marks a step in the supply side direction. And I say that with a large caveat of the company's management telling us over and over and over again throughout the call that they are not trying to do yield management. They're not trying to get into the supply side part of the business, and yield management's a large part of that. But they're simply trying to create a more direct and more personal relationship between advertisers and publishers, so that they can cut out other pieces of the value chain, such as a Google, so that they're less reliant on Google when they do things like erode third-party cookies, which is how we track users and identities on websites. So Trade Desk is really allowing advertisers and publishers to circumvent that with this product. Plus, it's vast treasure chest of first-party data that it has amassed over the last several years from being the market share leader on the demand side. So the quote from Jeff Green, because I bring this up because people were concerned about the Google announcement, just like they were concerned about the Apple iOS IDFA identity tracking announcement from last year. Which had absolutely no material impact on Trade Desk because of this first-party data moat that it's been able to build. And I hate using the term moat, but it does really fit here. So I will use it here. But so we got the quote from Jeff Green saying there will be no substantial impact going away from Google, because really what this does is it makes so what it's doing is eliminating a lot of cross-app tracking and data sharing, which puts the ball in the court of, and I've used that analogy I think 4 times over the last 2 days, but hopefully there's new listeners in this space. But really what it does is it puts this ball in the court of the advertisers and the publishers to do more modeling and more data mining to accurately price and pay for impressions, because Google's not helping out and not assisting as readily, just like Apple's not helping out and assisting as readily with their with their privacy changes. So this makes the reality of being a scale and market share leader all the more important, because when these massive third parties aren't playing ball and aren't cooperating, you need to lean on massive entities like Reuters and Walmart and Home Depot and Washington Post, and now Walgreens to collect enough first party data so that you can continue targeting in an effective way without invading on privacy, because they do have a UID2 or unified ID identity product that is really focused on encryption and hashing emails to ensure privacy. But it's really balancing the guarantee of privacy with an ability to continue targeting, so that this quid pro quo on the internet that we all know and love of being able to use Twitter and Hulu and all these amazing services for free in exchange for viewing relevant ads, that value exchange can continue, and we can continue to consume internet and content and entertainment outside of the Netflix model of you charge us a subscription amount for every single month. Without this effective targeting, we'd essentially be paying subscriptions for every single service we're using. So yeah, just wanted to put that out there. Speaking of Walgreens, so Trade Desk's new ad platform has been very key for bringing on retail partners, because what it does is allows more accurate connection of marketing dollars to sales dollars inside of an actual four-door retail center. So it's signed, as I mentioned, Walmart and Home Depot, and it has now signed Walgreens as of this quarter to build them programmatic advertising platforms so that they can monetize their impressions more effectively, to make them more profitable businesses and more appealing to third-party suppliers and to these advertisers, because the return on ad spend when spending with a Walmart versus someone using upfronts and not programmatic, or delivering them a better return on ad spend than this legacy model can provide. So I want to say I've used a lot of buzzwords over the last 10 minutes, and not to self-promote, but I do have a deep dive on the Trade Desk on my Substack. It's all free, and it does define all these buzzwords that I used if you're a little lost. So I apologize there, but sometimes I gloss over defining terms when I'm speaking super quickly in these spaces. So that's on me if I was confusing to anyone. But really strong momentum and really strong results for the Trade Desk. Number of customers spending over $1 million on their connected TV platform almost doubled in 2020, and that's doubling on pretty massive scale. I mean, it has 15,000 CTV advertisers in total. So this is not peanuts doubling from 1 to 2. This is doubling on a much larger base. They brought up a Renault CTV campaign that really highlighted the impact that their new ad platform, which is called Solimar, can have on return on ad spend and incremental reach. And yeah, they also just want to point out they continue to feel absolutely no material impact from iOS changes, as they've said in the past, and as no one believed them, but as came to fruition, just like they said. And they've also had no supply chain disruptions impacting their business in any kind of material way. So on the heels of a Meta call and or Facebook call, where they really blamed supply chain issues, and PayPal too, those are two holdings of mine, it was really encouraging from a Trade Desk perspective that they're not feeling this at all while they operate in this online digital space. But also a little concerning, not so much for PayPal because it's a totally different business, but Facebook monetizing ad impressions and saying supply chain issues are bothering us. But Trade Desk not being bothered by them was a little concerning to me from a Facebook perspective. But yeah, that's an aside, not important for this topic. But yeah, sum it up with 5 years of really strong results and 5 years of Jeff Green making very bold and ambitious promises and delivering every single promise that he makes. And at the same time, you look at valuation and it's at, I think, 70 times earnings for 2022. It will beat those earnings results if the last 5 years are any indication. So call it 65 times earnings. But that's not cheap in any environment. So while the success has been great, the bar for succeeding in the future is very high based on these forward multiples. So just keep that in mind. I've said a lot of nice things about both UpStart and the Trade Desk, and there are inherent risks involved in both investment cases, and those all need to be weighed and considered and contemplated before anyone jumps into either of these companies, which are high risk, high reward plays in the grand scheme of things when comparing the alpha opportunity and the loss opportunity to investing in a broad-based index fund like we were talking about before, which can be an extremely effective way to build wealth as well. But now I'm kind of rambling, so I'll leave it there and pass it on to Ev for our next topic.
I want to touch back and kind of use this to get some questions in on Trade Desk, UpStart, and kind of more in general. One thing that I do want to talk a little bit, I said earlier that a big point that I want people to get out of this is not necessarily, we're here about UpStart, I'm going to go buy UpStart, but what you're looking at when you're looking into these stocks, and maybe some of the terminology you're using, UpStart and Trade Desk as well, and some of the terminology you're using as well. And you actually did briefly talk about it there. So, like, obviously when you come into a new sector, new whatever, new stock, and you're trying to figure out the industry, it's really important to know the terminology in that industry. When you're going through that research and learning that stuff, is it really just as simple as you see terms you don't know, Google it, write it down, make sure you know it for the future? Do you have any like strategies in there or anything like that, or any concepts? Or I guess even in general, how important is it for you to know the full terminology and everything that's going on in a sector to be able to understand it?
Yeah, I require of myself to understand the ins and outs of every single industry I'm invested in, the absolute best I can, and it will be not quite as deep and intimate of an understanding as someone like Duvall, who is a great ad tech resource on Twitter, has by working in the advertising industry for several years. But I try to get as close to that as I possibly can. And how I do that, yes, Google searches, yes, reading every SEC filing and public piece of information I can get my hands on, but also leveraging this wonderful resource that is FinTwit. So, and I'll just throw some shout outs to people right now. Somebody like Josh Lancaster for UpStart specifically helped me greatly to understand the securitization process and the risks involved in relying on the securitization process. So hopping on a Zoom call with him for an hour was more valuable than I think maybe a semester of education has been in the past for me. So so leaning on resources that we have on the social media app and building relationships, I find very important. Duvall and Jordy is another great resource from ad tech. Richard Chu, I know a lot of us know him, helped me a lot with GoodRx and understanding how wildly ridiculous and complicated the pharmacy value chain is. So yes, I do require of myself to have a deep understanding of how the industry operates, just so that I can correctly understand and digest new news headlines and maybe more macro-based headlines and how they impact the future results outside of the control of my companies, but the future results that they will experience. So resources and friendships are a wonderful thing, and they've helped me really to be confident in knowing industries like the securitization market and the pharmacy market or pharmaceutical market and the programmatic ad tech market that I wouldn't have been able to understand on my own just reading Google articles in a vacuum. So that was a great opportunity for me to give them some shout outs, and they're well deserved.
Awesome. Always love to get good accounts, big shout outs. Twitter, FinTwit is one of the best tools if you're following the right people. There's a lot of wrong people to be following, and what's right for each person is different. But I'm always here for some good shout outs to some great accounts that have helped you along the way and you see some value. I want to dig a little bit more into Brad. We were talking earlier about how little time you can do these passive investing strategies, just DCAing it over time. I kind of want to pick your brain a little bit on how much time you spend a week focusing on investments and everything like that. And maybe it's hard to pinpoint like you need to be spending at least this much, but if there was like a minimum that you put it in, like if I put under this amount of work in per week, I would feel bad, or something that you could say, like just to give a ballpark range for the amount of work we got to put in to get as good as you in that area.
Yeah, I don't have a formula, so any formula I offer would be BS and would just be me kind of guessing. But I will say this is a full-time job for me. We'll be hopefully turning on the advertising monetization vehicle in the coming months with Bullish Studios. Not to get too personal, but so hopefully I can continue to permanently not charge for subscriptions. But yeah, this is a full-time job. So really, what I do is spend traditional work hours and I'm and usually more than that, but just compiling and digesting and condensing and surmising all of this information on the 24 companies that I own, so that I can really put it into and tie it into a neat little bow for everyone who's interested in the company and interested in following the company, but doesn't have 40-50 hours a week to do so, to digest the information in a really, really expedited way. So that's really what I'm trying to do. But if you're not deeply passionate about this and motivated and have time, if you just want to set it and forget it, then Decade's strategy is, I think, perfect. So there are different risk tolerances, there are different objectives, there are different paths, and you just need to figure out what works best for you. And for me, with the time that I have to sink into this and the passion that I have to sink into this, long-term investing in these growthy speculative stocks works, but it could be the absolute wrong strategy for you. So I think I'll leave it there.
100%. The right strategy is different for everybody. I love that 100% to live by. And, I do recognize that we are on FinTwit in a spaces for traders, investors. Obviously, this is long-term specific. And a lot of the people in here might be willing and wanting to put in that little bit, or a lot of bit, I should say a lot of bit of extra work to try and outperform the market. But, when you zoom out to the entire population, everybody that is investing, I think it's safe to say the vast majority of people really should be taking at least that passive strategy for, I'd say, majority of their portfolio. Whatever else is up to them. But
I'll just interrupt you rudely real quick and say, if you want to build wealth and kind of walk and chew gum at the same time, go ahead and put 80-90% of your wealth in index funds and use that 10-20% for more long-term speculative investments. It doesn't have to be 100%, 0%. So yeah, just I think there's no one size fits all, and just uniquely finding your path is so important. But I'll stop blabbering now.
No, let's dig into that a little bit more. We could talk, Brad. If you want to, Decade Investor, feel free to come on this. The idea of portfolio management, not just kind of going in and buying willy nilly, but really coming in with strategies of, I want to own X percentage of this, X percentage of that, and doing it that way. How important is position sizing, portfolio management, that whole concept to you? And what are some, if there are any strategies that you do and utilize there? Brad, we were just going for you for a while, so I'll throw that over to Decade Investor first, and then come back to you.
Yeah, I mean, I think it's important there's a lot of factors that play into it. I think the two biggest factors to me, in my opinion, and kind of what dictates my investment allocation into different risk investments, index funds, broad market funds is, I tweeted yesterday, I think it's important, at least in my opinion, for me, to have a solid foundation. So for example, I'm only 23 years old, so I have a really solid foundation in the stock market and a lot of broad market, like VOO funds, right? So I have a really, really solid foundation I've been building for the last 6 years. And then now, just recently, I've been diving into more riskier investments. And I think a lot of people are like, well, you're going risky. It's like, well, yeah, but I've also built a really solid foundation already. So I ran the numbers, I ran the math that with my risky investments, and a lot of these are super risky investments, if those go to zero, and I'm leading into them expecting they'll probably go to zero, but there's always potential that I'll be fine, right? Like my foundation is already set where I'm not forgetting about my foundation. I'm still adding my foundation every single month, but I've scaled back slightly on that to these more riskier investments where even if those risky investments go to zero, I lose all that money. My foundation is set and my foundation will take me to the promised land, right? So I think it's important, in my opinion, to set a solid foundation that, hey, if I want to go more risk, at least what I have in my foundation will take me to where I want to where I want to be. And, it also depends on a lot of factors such as how much risk do you want to take personally, right? Are you risk averse? Do you like taking on risk? Like you have that's, you best. So you have to understand that. What is your time horizon? So someone like me who's in my early 20s, I can take more risk than someone who is 65 that is retiring next year, right? As well as I'm single, I don't have any kids, so I don't have anyone relying on me that if my stuff goes to zero or I lose everything in my risky plays, that I'm not feeding my children, right? So there's that factor as well. And also another thing too to think about is, you have to just be able to understand that when you go for more risky stuff, and now when I'm talking about risky, like in the last couple of weeks, I've been really going super risky. So I'm like going extreme risk. I'm not talking about like individual stocks. I'm going like crypto stuff. So, but just, understand the risk when you get into stuff. And make sure that, hey, if this risk investment, whether it be, I'm going all in on this new EV company, right? Like a Rivian or something, or if you're going into whatever the case is, something even more risky, understand that, like, are you in a position where if that were to fail or not do what you want it to do or expect it to do, is everything else going to be set? Is everything else going to be okay? And again, that's all personal on a lot of different factors, but I think that's really those things are really important to understand your own asset allocation, risk allocation. And the last thing I thought of it right now as I was talking is also like cash flow, right? So if your cash flow, if you're strapped on cash flow, and you're working to make more money, but you just started, you're learning about all this stuff, different ways to build side hustles or whatever. You might not want to take as much risk as someone who has $5,000, $6,000, $7,000 or a couple $1,000s extra every month to invest, where they can take a little bit more risk. So there's a lot of factors that play into it. You best, but I think the biggest thing to like, if I just say one thing in terms of risk allocation and asset allocation, is how comfortable are you taking risk? You have to ask yourself that, because when you go and risk your investments, is there a higher reward? Yes, like that's how risk works, right? Higher risk, higher reward. There's also higher potential for it to go down more. So, are you comfortable seeing your portfolio go down 40% in a day, or 20%, like, a stock could, right? Like we've seen with like Snapchat or something. Or are you not like that and you don't want to see a 40% drop? You're not going to see the 40% incline either, but with like a broad market fund, right, you're also not going to see that 40% decline. So it really boils down to, like, how much risk are you comfortable seeing in your portfolio? Are you someone, if you see your portfolio down 10% for the day, you want to sell out because it's scary to you? You best, and that's kind of the biggest thing, is like, how much risk are you comfortable taking on? And what I would say versus what Brad says, versus what everyone else on here says, and everyone in the space, everyone has different risk tolerance. And so again, there's no right answer. The right answer is what is right for you. I know that doesn't really answer the question, but that's really the true answer to that when it comes to like risk tolerance and asset allocation.
No, I definitely do think that answered the question 100%. And even to add to that, like, with risk tolerance, I think that the most difficult thing with risk tolerance is being able to figure out what it is before you go too far. A lot of the times people figure out their risk tolerance by teetering over the edge and realizing, damn, that was that was a little too far for me. So, if you're ever doubting, if you're ever doing whatever, just know that is the general trend with figuring out your risk tolerance, is tending to go a little too far and saying, oh shit, and then having to come back a little bit. But if you can figure out your way to figure out what your risk tolerance is before, and obviously it's all personal, some people are better at this than other, that will help you at some point. So if you're ever doubting it, am I here, am I not? I would a lot of times go with your gut and how you actually are. Don't tend to push it just cause. But Brad, did you have any thoughts on this area, portfolio management, or any of the other topics we were talking about?
Yeah, I'll give off two brief ideas on how I kind of manage position sizing. The first one is I never buy a position all at once, and really, I say this a lot. Ridiculous valuations won't keep me out of a company, but it will keep me from investing 30 or 40% of a full position up front, and doing maybe 10 or 15% of a full position up front. So wanted to give that idea, and then along those lines, I think, especially for how I invest these speculative disruptors, I have to look in the mirror and acknowledge the fact that I'm going to be wrong on these. Sometimes I'm not going to bet anywhere near 1,000, but focusing on slugging percentage is how I'm going to succeed. So with that in mind, position sizing and maximum the maximum allocation and setting that limit, I just find to be so important. No matter how excited I am about a company, just respecting the fact that I can always be wrong. So for a GAAP profitable firm, that limit is usually around 4 or 5%. It depends for like a Revolve, which is GAAP profitable, but kind of a newer company, it'll be closer to 4. And then for a PayPal, which is GAAP profitable, but a lot longer public track record of compounding, it'll be closer to 5. And then for a Lemonade, which I do own, it's closer to 2.5%, 3% of a position. So not a science for sure, but definitely rough guidelines that I use for maximum allocation, and rough guidelines with the top end of those ranges really being strict limits. So yeah, I think especially because I don't hedge. I won't buy puts into an earnings call. Sometimes I'm tempted to, but I don't and I don't use option hedges. I don't use futures hedges. I don't short. So what I do is keep some cash on the sidelines for taking advantage of opportunities. And as things get really, really fun, I keep a little more cash on the sidelines. And as things get really, really shitty, I keep a little less cash on the sidelines. So yeah, it's definitely it's definitely a process that I continue to refine. But that's as a 24-year-old and a young person, just like Decade. But that is where I'm at right now, and that is, I think that's a good stopping point there.
I was actually going to ask you your age there because I'm 23 as well. I know Gav is 23 as well. I was going to make a nice joke about how we're all the same age, but we got an old man at the call on the call at 24. But I definitely do think in general that obviously has to shape the way you invest where you are in life, and that definitely has to be taken into context. And I think that we've said this about 10, 20 times on here. And, with this long-term investing space, we will get a variety of people on here, but the right plan, what is right for you, is different for everyone. There are some good strategies that can go across a lot of areas, like the passive investing, DCAing into these broad-based indexes over time. Like that is someone that I feel comfortable being able to say to most people that this is a good buy. But to that guy who's 70 years old, who needs the money right now, retiring, whatever, maybe it's a little bit different. The places in there. So I definitely think the context around where you are at in life, and that these plans are all personal to you, but you can still take the underlying concepts and kind of rework them for your style and everything like that. And I will also say for people our age, there is kind of a dislike of financial advisors and everything like that. And I'm not telling you go put your money with someone, do whatever, but sometimes it is nice to have a conversation with an objective person who can really kind of give you hints, give you leads and everything like that. So I'm not saying you got to do whatever you got to do, but having that person to talk to, whatever form they can be in, if it's a mentor or something like that, it is very useful as well. I'm going to quit blabbering here. Let us slide into wrap-ups. Before I do that, first of all, make sure you are following all of our amazing speakers up here. Big shout out to Brad for coming in and being kind of the co-driver of this long-term investing spaces for the last couple of weeks, and hopefully going forward into the future. He hinted at a little bit more, but hopefully we do some more cool stuff in the future with him as well, outside of just this. Big shout out to Decade Investor for coming on, giving his immense knowledge and sharing with you guys. Loved having him on here. And big shout out to Wolf Financial, the Spaces King, chilling up here with us and getting us some content as well. With that, I'm going to slide us over into wrap-ups. Wolf, I'm going to start with you just because we haven't gotten the chance to hear from you too much today. How are we feeling? Anything you want to add in on the long-term investing theme? And then also, what other spaces we got coming today?
However, for today, we have several more spaces, but big one that's following this is going to be in 2 hours at 3 p.m. EST. We're going to do a Bullish Rippers Power Hour. We are going to have, I think, exclusives going to be on that. Hopefully Stock Talk, PB, several others will all be joining up and being on there for 3 p.m. So if you're not already following the Bullish Rippers account, you're not just getting long-term investing, you're also getting power hours and much more out of it, industry specific, all that type of stuff. So a great follow. And after that, I'm basically going to go live at 6 for an NFT space. And I'm just going to do that for like 3 hours straight. So I have highlighting upcoming projects from 6 to 7, kind of like an AMA style. And then 7 to 8, or 7 to 8:30, I have like an NFT alpha space. And then 8:30, I have the Hall of Famer, Sugar Rashad Evans from the UFC coming on and talking about his project. So I'll basically be live a lot more hours today.
Shout out to that. At least 6 to 8 hours screen time on Twitter Spaces. Love to see it. Putting in the full-time work there. I see the Wolf account in the crowd. Make sure you're following that. But I'm sure the Gav account will be up on a lot of those spaces as well. So definitely another good account to check out. I see the Wolf account back up here. I'm going to keep us moving. Big shout out to Wolf for always being on these spaces, helping us out and putting out some great content. But I'm going to slide us over to Decade Investor. let's talk a little bit and give me a wrap up, how we're feeling, anything we got going forward. And then I would love to hear a little bit more of the stuff that you're doing on the back end. If we got any newsletters, I see the ZZZ Money Club. Wow, I'm having trouble speaking right now. In your bio, maybe tell us a little bit more about that as well.
Yeah. Again, thank you all for having me on here. Love going on spaces and talking about just investing in general and learning. That's why I like coming on here, is like people like Brad that put out some crazy information and good stuff. So again, thank you for having me on here. But yeah, I think my biggest wrap up or biggest takeaway from this space that I talked about is just, if investing is a crazy thing, like if you're new to the game, you open up your account, Robinhood, Fidelity, any account out there, and you're like, what do I pick? Like, I don't know what the heck this is. Like, what do I do? Don't be afraid to A, ask questions of people, and B, and when it comes to like dollar cost averaging, like simple is fine. I know in investing, it can be kind of crazy. It's like, well, do I have this many holdings? How many hold? If someone had said, hey, you only get one holding, like I would just buy a simple broad market fund and dollar cost average into it. And like, yeah, you're not going to get the flashy returns, you're going to get all that stuff, but it can take you to the promised land if you have enough time and, you continue and stick with it. And so the biggest takeaway there is just, hey, dollar cost averaging, it's into broad market funds. Like, it sounds boring. It doesn't sound like cool, but it works. It's worked for many years. And I can myself think it will work for many years to come. And so, but what I'm working on the back end, I just spent a lot of time. I spent the last like 2 or 3 weeks diving into like the crypto space a lot more. And so, yeah, in my bio is the app to my Discord community, where I work with one of my friends on Twitter. His name's Your Friend Andy. So he's all of our friends now. But Your Friend Andy, we talk about like crypto passive income in there, stocks, all long-term investing stuff in that Discord. And we have a good amount of members in there hanging out every day, spending time teaching about different projects, different ideas, different stocks, talking about just kind of what we're doing here. But yeah, that's what I work on the back end. And just like Brad, I don't spend a lot of time in researching my broad market funds, because like it's all automated, but I spend a lot of time, I do this full time. So I spend a lot of time researching other stuff like stocks and crypto and all that stuff. So I do it all, try to do my best I can to put out the best information possible. So everyone that followed in this space, thank you so much. And hope I can keep you all following with good information. But again, thank you for having me on here. And simple dollar cost average. That's my takeaway.
Awesome, dude. Appreciate you. For everyone in the crowd who hasn't followed Decade Investor yet, make sure you do that. Go in, click in, and check out his profile. Some great content as well. And he also hit at it there. The truth of it is, following is really easy, but also hitting that unfollow button is just as easy. It doesn't let us know, and you can really do it whenever. You're not going to want to unfollow the people, the people after you see their content. Decade Investor, Brad, Wolf, all have top quality content. But the option is there. There is literally no risk in you hitting that follow button. I can 100% tell you the knowledge that came out of these people's mouths on this space definitely at least deserves you clicking into their profile and checking out and giving them a chance. So definitely do that. Big shout out to that. And I will throw us over to Brad.
Yeah, nothing much more to add. Enjoy the conversation as always, Decade. Always fun to talk with you. Looking forward to earnings season continuing next week. Teladoc, Revolve, Olo, and Lemonade for me are the four reporting, and yeah, excited for a lot more information and a lot more forward looking guidance to come across for me to kind of to go through. So thanks for having me as always, and talk to you guys tomorrow.
Love it, no problem. And also, I fat fingered below and by accidentally brought up Rod. So hey, my mistake. It is your lucky day. I guess we're gonna get an impromptu question in here at the end if you do have one. Rod, we got anything?
Hey, what's going on, guys? So if you realize, like, a lot of people call me Rod, but I don't know if you guys are old enough to remember the movie Rod Tidwell, which was a character played by Cuban Gooding Jr. in Show Me the Money with Jerry Maguire. That was paid by Tom Cruise. I think I asked this question before, but I want to reiterate it again. You guys talk about dollar cost averaging as being a way to invest, right? Many generations have been believed that, kind of buy and hold is like the ultimate market knowledge. But like in today's market, I think the charting method has kind of like stood the test of time. And help the uniform investors navigate, treacherous trading and investment environments. And I want to get your guys' thought, in terms of market cycles. It's hard to kind of say, okay, where we at? You don't know where we're at until that phase is all over with. But just want to get you guys realistic thoughts. Like, do you believe that right now in this current environment, we're looking like we're in a distribution phase? Now, I'm 35 years old. My profession is an auditor, so I always have professional skepticism when it comes to things. And from my chart and from my technical analysis, I see a lot of overextended stocks. And I'm not the smartest person in the room. But I look for folks who are smarter than me, and some of those individuals are Ray Dalio and Warren Buffett, and they have more money than me. And when I hear that Warren Buffett hasn't pretty much bought anything besides Berkshire, it just makes me ask that question. Where are we at in the market cycle? And right now, would it be the greatest idea to start loading the boat or dollar cost averaging right now when it looks like the Fed is going to be cutting spending? We have inflation. There's so many negative catalysts. You can go back and you ask yourself, you're like, well, damn, the writing was on the wall. Why did I do this here? So that's the question. I'm not a bull. There's three animals in the wall: bull, bear, and a sheep. I'm not a sheep. I'm typically, I trade mostly to the downside. I look for overextended charts, things that falls outside of the, their norms and valuations, and I look to go short that way. I do play the bull side sometimes, but generally speaking, I'm a bear, and that's the way I like to play, and that's how I made my money. But I just want to get you guys' thoughts on currently, like, where we're at in the market cycle, and do you think it's the best opportunity to start investing if you were young?
Yeah, I can take that and hand it off to Decade Investor. So I can't comment on the specific companies you're calling overextended, just because I'm so micro focused and so singularly focused on these 24 companies that I own and follow so religiously. But for me personally, I'm seeing a lot of these 30-40% revenue compounders now trading at market earnings multiples of around 30. And to me, in any market environment, when you have these companies with the opportunities ahead and the track record of success they've had for taking these opportunities, and the 30-40% top line growth, I'll pay 30-40 times earnings in any environment for that kind of company, and do so happily. So looking at a company like Progeny, which is compounding for the next 3 years at a rate above 40%, and now fetching an earnings multiple of around 40 times. So looking at a PEG ratio of around 1, it doesn't seem stretched to me. But again, you could be looking at other companies that look extremely stretched, and I have a hard time commenting on those just because I'm so in a vacuum on these 24 companies and the industry. So I wish Stock Talk Weekly was on this call so he could answer more intelligently than I can here. But in terms of what I'm looking at, my universe, that the deals are looking compelling, and I do think that the last 6 months of anticipation of balance sheet runoff and federal funds rates going up has priced in a lot of this multiple compression for these speculative disruptors. And I will also say that I don't see a 1% or 2% federal funds rate as really a reason to become super alarmed about holding companies at 30-40 times earnings, when you're still paying a 50 times earnings multiple for a 2% yield on the 10-year. So that's kind of how I see it. And again, such a specific answer from me that you could be looking at a different cohort of stocks and companies and could be seeing absolutely correctly overextension and express caution. So I can't comment there, unfortunately.
No, I appreciate your thoughts and your perspective.
I have some thoughts there too. I think you kind of asked a different question kind of in there a little bit. Like, is it time to load the boat? Is it time to dollar cost average, for the person, for the long term? And the answer is we don't, like you kind of hit it on there. We don't know where we're really at in the cycle until after it. And it's really difficult. But I think this kind of goes at to what Decade Investor was saying about, for the person who's dollar cost averaging into these broad-based indexes, I do think you are still good for dollar cost averaging now. And like, what does dollar cost averaging mean? It's not loading the boat, it's buying it slowly over time. And the reason I say that, like, yeah, I do see short-term risk ahead in the next 3 to 6 months. It's not like I'm expecting a rally. There's a lot of headwinds coming. But, for that person slowly dollar cost averaging in over time, I think it's really important to stick to your plan And, when you look back on the situations and look back on everything, I do think you'll be excited that you'll be happy with yourself that you continue buying instead of, modifying your plan to maybe get it right, but then you end up getting it wrong more than you get it right in the end. So for the broad-based index passive investor who's dollar cost averaging slowly, like I will say, honestly, pretty much any market condition, when it's your time to buy in, if you're doing it, you're doing it in the correct way, I would say it's a good time. But we look at the headwinds in the short term that's going forward. Like there's a lot of happening right now, and the market is really good at digesting one thing at a time. When it was just the Fed, when it was just whatever, we were okay. We were able to go sideways. We were able to do stuff, but like there's a lot of stuff coming together. Coming at once, and it will be. It just doesn't make me think that, okay, we're going to be running into this environment where everything will be sprinting. So, I can't say you're wrong, and I do think we are definitely later in the cycle. But for the person in my position who doesn't want to put that extra work in and broad based, as I've said like 5 times in here, I still think it is a decent buy time. Or every time is you get what I mean. Decade, you have any thoughts you want to jump in there, throw in there?
Yeah, I mean, I think as someone who spends a lot of my time just doing, with my money, I guess, is in more broad market stuff. I agree with you that there's really, I don't see a bad time to just simply dollar cost average. But when in terms of loading the boat, I think I agree with Brad that some of this speculation on the interest rate hikes are priced in. I think when the exact, whether it's 25, 50, how many basis points the hike is, once that gets announced, I think we'll see something in the market. But I think a lot of it's already priced in based on, everyone knows it is coming. It's just a matter of when and how much it's going to be hiked up. So, I don't know. I would have to see the exact markets you're looking at or the stocks in particular, because I'm agree that, in every cycle, you're going to have stocks that are overextended and ones that aren't. And so it boils down to, specifics. But in terms of just the overall investor, just simply dollar cost averaging, we look at guys like Warren Buffett and Ray Dalio that, Warren Buffett, that I study a lot too, sitting on a lot of cash and holding off. And, I think that's great. But for someone who's just simply not looking to go, all in on one stock or one area, just wants to simply dollar cost average, sitting at a 7% down in the S&P. Again, that's only since like October, so it's not like anything crazy. But I think a lot of that it could be already priced in. And so for that simple dollar cost average investor into an S&P or like a VTI, which is total U.S. stock market, I would just say what I'm doing, and you guys can make your own opinion off that. But I'm just simply doing what I've always done, is just buy every single week into it. Because we don't know what the market's going to do. We can look at specifics and stocks, but even then, we don't really know. And so all signs stock market's weird. All signs can point to yes, and they could be no. But I agree, Rod, that there are certain things that could lead to certain stocks being overextended. It's just a matter of which ones, and will that, do we believe that's going to happen or not?
Perfect. All right, awesome, Rod. I keep calling
Thanks
you
a
that,
lot.
even though
Appreciate
you
it.
explain the name. We appreciate you coming up. Appreciate the follow as well, and glad we can get your question answered. Hopefully, it was. I know it definitely added some value to the space, but hopefully, you got some value from it as well. Big shout out to Brad, Wolf Financial, and Decade Investor one more time. We got a bunch more spaces coming later today. Make sure you're following the Bullish Rippers account. Make sure you're following Brad, Wolf, and Decade Investor for some top class content. And we will see you later. Everyone have a great trading day.